Hi everyone. So welcome to the live stream today. Very much excited for having you again on the live stream as we continue with our discussion towards the ICA November 2021 examination, as we touch on the various issues that we need to focus on in order for us to increase our chances of passing the examination, and most importantly, take our lives to the next level. And today we're looking at one of the most basic accounting standards in financial reporting and corporate reporting, and that is IAS 12, income tax. Now, this standard is very basic, it's very critical, and you're going to be meeting it one way or the other in your exam hall. And that is what we want to discuss briefly and share my thought with you on how you can actually know how to treat the standard and how to answer questions relating to this standard. Now, I see some of you guys joining the stream. You are welcome. Give us a thumbs up when you join the stream. It helps us a lot so we can reach many students. We are live on LinkedIn and also live on Facebook, as well as live on YouTube. So let me know where you're watching us from. Give us a thumbs up on the video. Put in the chat any questions you have for me as we get into the discussion today on IAS 12, income tax. IAS 12, income tax, one of the basic accounting standards that we want to look at today in that case. Right, I see some chat coming in. I'm going to be looking at them real quick. YouTube, I see you guys joining. You're welcome. Facebook, I see you guys joining. You're welcome. And share the video. Let us reach as many students as possible watching this live stream, as the standard is very critical for students preparing for the corporate reporting or financial reporting examination, ACCA F7, and then ACCA SBR, strategic business reporting, because this is going to be critical for all these subjects in that case as we get into the discussion for today. Now, if you have any questions, you know what to do. Put them in the comments, put them in the chat for me. I'm going to be answering all of your questions for you and providing you with some blueprints on what exactly you need to do. And if any questions you have, just put it in the chat. I'm going to be really looking at it in that case. I see some comments coming in. Precious Okechi said, good evening, sir. Good evening, Precious. I hope you're doing well. Thanks for joining us. Monalula said, good evening, watching from Zambia. Okay, that's great. Kweku Barton said, good afternoon, Nhyira. Good afternoon, Kweku. Vincent Bolster said, good evening, Nhyira, watching from Tanzania. Thank you for joining us. Eswatini approves Nhyira Premium. What is Eswatini? I don't know what Eswatini is. What is Eswatini? Is it a country? I think so. It's a kingdom, I guess. I don't know. So let me know what that is. Ilo Austin said, good evening, Chichi. Good evening, Chichi. Watching in from Nigeria. Okay. Thanks for joining us. Chimoka said, good evening, sir. Glad to be here. More blessing upon you from Zambia. Thanks for joining us today, Chimoka, as we get into it. Mona Luna said, former Switzerland. Okay. Yeah, I just checked it as well. It's officially the Kingdom of Eswatini and formerly and still commonly known in English as Switzerland. Okay. Okay. So that's a country, I guess. Thanks. All right, so let's get into it real quick. Bashiru Shani said, good evening, Nhyira. Good evening, Bashiru. Thanks for joining us on the live stream. Nicholas Samwini said, good evening, boss. Watching from Tumu, Upper West region. Thanks very much, Nicholas, for joining us. Always a pleasure coming your way. Share the video. Let us reach as many students as possible. We want to see if we can get about 100 people on the stream on all the platforms that we are streaming on. Let's see if we can get as many students as possible. Let's together push the video so we can assist a lot of students preparing for the exams. Like I said, this is IAS 12, one of the basics accounting standard, but also very simple. This is one of my personal favorite standards, IAS 12. The reason is that it is simple, straightforward. When you get a concept, it's very easy, but many students struggle with the accounting standard for some reason, but I think IAS 12 is one of the simplest accounting standard by all standard in that case. So let's go into it and let's see exactly what we need to do in that case. Francis Abugri said, great work, bro. Great work, bro. Thank you, Francis. Osmano Amwakwa said, good evening, sir. I'm enjoying from Winneba. Thank you very much, Osmano. Welcome to the live stream. And let's get into it real quick. Let's get into it real quick. Okay, let's go. So let me bring out my screen and let's catch the train and let's hop on to IAS 12 income tax. Now, share your thought with me. How many of you have learned this standard before? What's the challenge about this standard? Share your thought with me real quick. Put it in the chat. What's your experience with IAS 12? What's your area of challenge when it comes to dealing with this particular accounting standard? Because I understand that is one of the standards that students are excited about. So let me know. IAS 12 income tax. What's your challenge about this standard, or what is it about this standard that you don't understand that you would want me to really highlight on or share my thought on? Let me hear from you in the chat real quick. In that, as we begin the journey, Dennis Mensah said, good day, boss. Glad to see you once again. Watching from University of Winneba. University of Education, Winneba School of Business. God bless you, sir. Thank you for joining us, Dennis Mensah, and shout outs to all your colleagues in the University of Education, Winneba. So share with me, IAS 12, what has been your experience with this standard? Do you love it? Do you hate it? Do you enjoy it? Or what really is a take on the standard in that particular case? What's your take on the standard in that case? Now, when it comes to IAS 12, income taxes, like I mentioned, is one of the basic accounting standards that we need to be aware of. But then there are a couple of things that we need to understand when it comes to dealing with this standard generally. Now, the idea about IAS 12 income tax is that entities are required that for whatever transactions or events that they undertake, whatever transactions or events that they undertake, they must record both the current and the future tax consequence of those transactions and events. Now, that is the starting point. That is the starting point. Whatever transactions and events. So that's the principle I want you to get into your mind. Entities must record and account for their current and future tax consequences of transactions and events. Now, why is that? The reason that is that businesses are there to pay taxes. And businesses will pay tax on various items, various issues. For that reason, IAS 12 requires that for whatever transaction, whatever event that an entity undertakes, that an entity comes into contact with, that an entity is going to incorporate in its financial statement, the entity must account for both the current tax effect of that particular or those transactions and then the future effects of the transactions. So let me give you some examples. Let's say an entity buys a property, plants, and equipment. So an entity buys a property, plant, and equipment, and the entity intends to use it for the day-to-day running of the organization. So if it is for the day-to-day running of the organization, then the entity accounts for this asset in accordance with IAS 16, property, plant, and equipment. But if the entity decides to maybe let's lease the asset out, or rent out the asset, then the entity is going to be accounting for the asset in accordance with IAS 40, investment property. But the question that we ask ourselves all the time is, okay, what is the tax effect of those assets that we have bought? Because the tax authority, when they come, they're going to be disallowing depreciation on the asset, but instead give capital allowance on the assets. These assets, if we should sell them in the future, there has to be either an allowable deduction or an additional tax we have to pay at the end of the day. So you realize that when the entity buys the asset, the entity will be carrying the asset either at its carrying amount or at its fair value. Okay, the asset will be carried either at its carrying amount or at its fair value. For that reason, we would have to find out what is the tax implication of these assets. And I'll come back to this in a moment. 2, when entities give motivation to their employees in accordance with IFRS 2, share-based payment, okay, share-based payment, that could be in a form of either a share appreciation right, or it could be in the form of share option. Whatever be the case, what is going to be happening is that there has to be a tax effect on this, because the entity is paying some money to its employees, and those employees, those money they receive, the tax authority will charge them tax on it. Now, those money that the entity is paying, either in shares or in cash, the entity is spending money. The tax authority would have to reimburse the entity in that particular case. So when it comes to IFRS 2 share-based payment, there is going to be a deferred tax asset that we would have to deal with in that particular case. And I'm going to explain this later on as we proceed with our discussion. So it could be property, plant, and equipment that we've bought, and we are using it for the day-to-day running of the organization, or it could be a property, that plant and equipment that we bought that it is a non-owner occupied, and we are accounting for it in accordance with IAS 40, investment property. In either case, IAS 12 states that we must account for both the present tax consequences of this and then the future consequences of that as well. IFRS 2, we give incentives to our employees. Yes, it is very important for us to account for the tax consequences of this share-based payment offer that we are undertaking. Or, better still, the entity makes an investment. Probably investment in associate. When it comes to the investment in associate, for tax purposes, or for IFRS financial statement purposes, the entity is going to be accounting for this in accordance with IAS 28, investment in associate and joint venture arrangement. However, IAS 12 requires that we account for the deferred tax effect of this particular investment that we have just made in the associate. So either property, plant, and equipment, either share-based payment and incentive we are giving to our employees, or it could even be an investment we are making as an organization. Whatever it is, whether it is a liability we are going to be paying in the future, it is a revenue we have received or we are likely to receive in the future, whatever it is, IAS 12 states that we must account for both the current tax consequences and then the future tax consequences of that particular item. This is the basis for IAS 12. Now, off the bat, I have just shown you that IAS 12 actually has a connection with IAS 16, IAS 40, IFRS 2, IAS 28. So you realize that again, IAS 12 does not work alone. Like I tell you all the time, you do not learn the standards on your own or alone. You must learn the standards in conjunction together with the other standards as stated in it, so that you'll be able to understand and treat the standards better. So whilst you are dealing with IAS 12, Note that it has some relationship with IAS 16. Note it has some relationship with IAS 40. Note it has some relationships with IFRS 2. And note it has some relationship with IAS 28 and other standards that IAS 12 may have some relationship with. So that is the background. That is the backdrop. Whatever transaction, whatever event that an entity is undertaking, at the end of the day, the entity must account for both the current tax effect as well as the future tax effect of that particular transaction. Any questions for me? Let me know. What is your thought on IAS 12? What has been your experience? What's the key area of this standard that you are not excited about, that you find challenging as an FR student or CR student in that particular case? So let me know. Let me know in the chat. Let me know in the chat in that case. So now that we've gotten the introduction out of the way, let's get excited to look at the specific issues that we need to look out for. When dealing with income taxes, two things must be in our mind as we are preparing the financial statement. How much income tax must be recognized in terms of the current year tax, and how much must be recognized in terms of deferred tax. And I'm going to explain this in a moment. So when it comes to income taxes, we can have current tax and we can have deferred tax. Stay with me carefully. I'm going to unpack all of these for you in a moment. So we can have current tax, we can have deferred tax. The third category that we need to have about income taxes has to do with over or under provision of tax. Over or under provision of tax. Stay with me carefully because we are beginning to unpack. So when it comes to dealing with income taxes, three things basically we need to understand: the current year tax, over or under provision of taxes, and then deferred tax. Note that always, as a rule of thumb, the current year tax goes to the statement of profit or loss and other comprehensive income. The statement of profit or loss, and so it goes to the P&L account basically. Over or under provision of tax, I'm going to explain that also in a moment. That also goes to the statement of profit or loss account. But here is the most interesting aspect. When it comes to deferred taxes, it could either go into the P&L account or into the OCI. Stay with me. I'm going to tell you when it goes to where in that particular case. So stay with me carefully in that. So when it comes to income taxes, there are three things we must know about: current year tax, deferred tax, over and under provision of tax. Now, current year tax always goes to the profit or loss. Over and under provision of taxes always goes to the profit or loss, but deferred taxes can either go to the P&L accounts or the OCI. Other times we will split it. Part of it will go to the P&L account, the other part will go to the OCI in that particular case. So let's get excited about it, and then let's pick them one after the other and talk about them real quick. Current year tax. Current year tax. Usually, current year tax is simply the estimate of tax payable based on the accounting profits of the entity. Okay, so it refers to the estimated tax payable by an entity based on accounting profit. Based on accounting profit. So usually we're going to be finding this in the footnotes to the financial statements. So the examiner would tell us that, okay, the entity has estimated that tax for the current year is, say, $10,000 or $20 million or $30 million. Whatever estimation that we have, it's going to be in the footnote, and that directly has to go to the P&L account. That has to go directly to the P&L account. So when it comes to the current year tax, there is no cause for alarm. Whatever figure that is given to us, it is going to go into the P&L account, because that is the tax estimate that the entity wants to have. But this is a sweet spot. After the current year tax, we come to the second category, and that is the over or under provision of tax. Now, stay with me carefully here. The idea about over or under provision of tax comes to being because, remember, the entity or entities always pay tax 1 year in arrears. So whilst preparing the financial statement for, say, 20x1, the entity will estimate that based on the 20x1 profit, we're going to pay a tax of, say, $10 million. Now, remember, that tax they expect to pay is usually based on accounting profit. Usually based on accounting profit. But the tax authority comes, and when the tax authority comes, always, what the tax authority is going to come and say that, hey, in the year 20x2, that is the following year, when the tax authority comes, the tax authority will say, okay, based on the taxable profit, stay with me carefully, based on the taxable profit, you're going to be paying a tax of, say, $12 million. Stay with me carefully. The entity had estimated, based on the accounting profit, that they will pay a tax of $10 million. But when the tax authority comes, they are going to readjust the financial statement. And based on the readjustment of the financial statement, they will conclude and say that, no, you're not going to pay $10 million. You're rather going to pay, or your tax liability is going to be $12 million. What has happened here is that there is an increase in the liability of the company. That extra $2 million we will pay in the current year, as compared to the provision we've made, is called under provision of tax. Does it make sense? Under provision of tax. So the entity had provided for the year 20x1 $10 million. But in 20x2, as the tax authority comes, the tax authority say, you're going to pay $12 million. The entity had already provided for $10 million, which means there is an additional money that the entity had to give to the tax authority, and that is $2 million. That $2 million is termed as under provision of tax. Always note that when there is an under provision of tax, it increases the current tax, or it increases the income tax in the P&L. So we add it to the current year income tax because you have under provided. Increase in liability is an expenses. Increase in liabilities is an expenses. The reverse is true. So let's say that in 20x2, when the tax authority came, the tax authority, based on the taxable profit, the tax authority said, hey, listen to me, you're not going to pay, we don't know how much you even provided for, but based on our calculations, you're going to pay a tax of, say, $7 million. Uh-oh, guess what? Guess what? The entity had provided for how much? $10 million, but the tax authority says you are going to pay only $7 million. What does that mean? That means that there is an excess of $3 million. This $3 million will be termed as over provision of tax. Over provision of tax. Now, when there is an over provision of tax like that, what happens is that it reduces the income tax to the P&L. It reduces the income tax to the P&L. Why? 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 Because a reduction in a liability is an income. Sounds good? A reduction in a liability is an income. Increase in a liability is an expense. Reduction in a liability is an income. So under provision of tax increases the current year tax figure in the P&L account. Over provision of tax reduces the current year tax figure because there is an income coming in that particular case. That is the idea about over and under provision of tax. Does it make sense? Sounds good? Any questions, you'll bring it up in that particular case. Now, then the most exciting thing that we need to ask ourselves is, all right, Nhyira, we got it. In the trial balance, what's going to happen is that you're going to have, the trial balance, you see debit, the trial balance, you see credits there. And the examiner is not going to tell you this is over or under. So the examiner is going to just write over or under provision of tax. Over or under provision of tax. And in some circumstances, it will be on the debit side. In other circumstances, it will be on the credit side. What you want to do is that when you are preparing the tax account, whatever side it is on, you bring it to the amount side in that particular case. Whatever side that is on, you bring it to that side in your T account when you are preparing the income tax account in that case, so that you don't have to think, is it over or under? When you are preparing your T account, if the over or under is on the credit side, take it as balance brought forward to the credit side. If it is on the debit side, take it as balance brought forward to the credit side. But in some circumstances, you have to interpret or understand, if it's on the debit side, what the heck is that? And if it's on the credit side, what also is that? So it's going to be simple in that particular case. It's going to be very simple in that particular case. Now, I see some of you guys joining on YouTube. You are welcome. This is our session on income tax liabilities or IAS 12 income tax. Give us a thumbs up on the video if you're getting some value already. Some people are joining us as well on Facebook. Share the video. Let us reach as many students as possible joining the live stream. So share the video on Facebook, share the video on YouTube with your friends in various groups. Let's get to many students as possible. But most importantly, put in the chat for me any questions you have as we continue with our discussion. So note, if it is on the debit side, that means it is an under provision. So it's an expenses. Okay, so you add it to the current year tax provision. If it's on the credit side, that's an income. That means that is what? Over provision. It reduces the current year tax liability. Sounds good? Sounds good? So the reason why I wanted to understand this is that some of you, when you're preparing the T account or when you're doing the income tax, you don't like the T account. You like to add the figures up. So if it's on the debit side, it is under, you add it to the current year tax. If it's on the credit side, it is over, you subtract it from the current year tax provision. That is the second thing you must understand when it comes to IAS 12, over and under provision of taxes. Any questions for me? I see some questions coming up. Let's see if we can take them real quick. See some questions coming up. Let's see if we can take them real quick. Let's see what we got. Let's see. Roland Kujo said, good evening, Professor. Good evening, Roland. But I'm not a professor yet, so please, I don't want to be in trouble. Solomon Lum, what is that? Kumsin. I wanted to say Lumsin. Sorry, okay, Kumsin. Hi, Nhyira. This is Solomon. I'll be glad to know how to unravel the complexities typically presented with this standard in examination condition. I'm already unraveling it. So stay with me carefully as I bring them out for you. Who is this? Soon. I'm trying to pronounce the name, but I'm not getting it. Soon, but let's see. Please, I don't know if I don't pronounce your name well. Please forgive me. Joining for the first time from Nigeria. Well done, Nhyira. Thank you for joining us soon. Oluwa Tohid said, what? Deferred tax is the most challenging in IAS 12. Don't worry, it's going to be very easy for you. I can guarantee you that it's not difficult. Thank you for this. That is for Hats. Okay, you're welcome. Precious. Okay, she said, Nhyira, my main issue with IAS 12 is accounting for deferred tax. Don't worry, I'm coming there in a moment. Then SN Wa said, joining for the first time. Thanks, you're welcome. Then Premium Golden Show said, sir, is there any difference between corporate tax rate and standard income tax rate and their treatment in the computation of income tax? I need to get a context in which you are asking the question, because the corporate tax rate is the tax rate that the company is supposed to use and on which they pay tax for. So for instance, if you're in the UK, the corporate tax rate is around 19%. If you're in Ghana, depending on where you are, you can pay a corporate tax rate of 25% or 22%, or based on your location, whatever tax rate that you're supposed to have. But then standard income tax rate, I don't know the context in which that is. So probably if you provide me with some context, I can answer much better. Monyake said, seems like you only mention assets. What about the deferred tax implication on liabilities such as provisions? We will come to the deferred tax implication. I didn't talk about only assets. I mentioned in my intro that all events, all transactions, whether assets or liabilities, there has to be a deferred tax implication. Because when I spoke about IFRS 2 share-based payment, if you are giving share appreciation right, that's a liability. So there is a deferred tax, and always when there is deferred tax on liabilities, it is always going to be deferred tax asset in the books of the entity, because the tax base of it is going to be 0, and then the carrying amount is going to be what we're going to be carrying out. Laura Machaka said, good evening, sir. Good evening, Laura. Thanks for joining us. Premium Show said, yes, deferred tax liability will increase their entity tax burden. Okay. Let's see who else we got. Frederick Ohini Kina said, what is the current year tax? What if the current year tax is provided in percentages, say 20%? Okay, so in that case, when you prepare your income statement and you get a profit before tax, then you do 20% of the profit before tax, and that will give you the current tax estimate. Frederick, did you get that? So in that case, you prepare the income statement, and when you finish preparing the income statement, when you get to profit before tax, on that figure, you express the percentage that is given to you so that you can get the income tax for the year. Laura Machakat said, deferred tax and assessed losses change in tax rate are a challenge. Okay, we'll look at that. Christiana Ezuma said, hi, Nhyira, this is my first time of watching you live. I am blessed today, from Christy. All right, Christy, I also like to have you, so welcome to the stream today, and I hope that you'll be joining. Weldon said, what is the difference between accounting profit and taxable profit? Right. The difference between accounting profit is that is the profit of the entity based on the entity's financial statement. So when the entity is presenting the financial statement, what the entity is going to do is that as part of its expenses, it is likely to include things like depreciation. It is likely to include other expenses that may not be allowable for tax purposes. When the tax authority comes, they look at the financial statement of the entity and say, hey, depreciation cannot be allowed. You broke the law, you breached the law, and you paid some fines. For accounting purposes, you account for those things, but when you are dealing with your chargeable income, we won't account for it. So accounting profit is a profit from the perspective of the entity based on the application of the accounting principles. Taxable profit is the profit of the entity taking into consideration the tax effect of the transactions of the entity. For that reason, Taxable profit is the profit of the entity for the purposes of tax or from the perspective of the tax authority. So, Tawhid Oluwasin, I hope that makes sense for you. Chimoka said, accounting treatment and reconciliation of deferred tax on revaluation surplus and credit balance in the trial balance. Okay, we're going to be looking at that in a moment. Samuel Quasin said, hello, sir. Trust you are well. Still learning from you. Oh, Samuel, yes, I'm doing well, and I hope that you are also doing well. Yeah, it's good to be learning, even if you are chatted. And so thanks for joining us in that case. I think I skipped some comments. Irene Labi said, good evening, Nhyira. Hope you are good. Yes, Irene, I'm flourishing, and I hope you are also flourishing. Cosmos 3030 said, good day, sir. Please, I want to know whether MPV and payback calculation in FM applies the same in MA. Yes, please, they apply the same in MA. And possibly next week, we're going to be looking at investment appraisal techniques, and that is in FM, MA, strategic case study. So stay tuned for that, and we're going to be looking at it in that case. Okay, so let's go. So we have looked at the various things that we need to understand. Like I said, there are 3 things you must look out for: current tax, over or under provision of tax, and most importantly, deferred tax. We've discussed the current year tax, no problem about that. The over and under provision of tax, we've looked at the various adjustments that we need to do. But the third category is going to be deferred tax. Deferred tax. What is deferred tax? In a simple language, when we say deferred, deferred simply means, the word deferred means something that is supposed to be happening in the future that you are trying to recognize now. So when we say deferred tax, it is simply the future tax consequences of a transaction today. Okay? The future, in a simple language. Okay, I'm not trying to give you any mechanical definition. I'm giving you my favorite KG2 definition. So it refers to the future tax consequences, or if you want, the future tax effects of a transaction or event recognized in the current financial statements. Recognized in the current financial statements. So the thing has not happened. The thing may not happen, but we are recognizing in the financial statement currently the future consequences of that transaction. That is the idea about deferred tax. So it is a tax that you are likely to pay in the future, or a tax deduction that you are likely to receive in the future, but then you are recognizing it now so that in future, when the event against which you are recognizing it occurs, you've already accounted for the tax effect of that event. That's what we're talking about. That's what we're talking about. So let's get excited about it. Let's get excited about it, and let's see exactly what we're going to do. So when we say deferred tax, what is it about? Yes, it is the future tax effect of a transaction or event recognized in the current financial statement. But in a nutshell, how does it come by? Deferred tax come by due to the way an entity recognizes its transactions and events as compared to the way the tax authority recognizes the transaction or events. What does that mean? What does that mean? It means that deferred tax arises due to the differences between the carrying amount of the transaction and the tax base of the transaction. Very simple. So the carrying amount of the transaction is how the entity is carrying the assets in its financial statement, how the entity is recognizing the liabilities in its financial statement, and the tax base is the amount attributable to an item or event for tax purposes. For tax purposes. Why is this so? It is so because the way an entity recognizes a transaction is not the same way the tax authority recognizes transactions. So an entity may buy an asset, and as per IAS 16, the entity may have to do what? Revalue the asset using the revaluation module. Or as per IAS 40, the entity may have to carry the asset at fair value. The tax authority does not know that. As the entity has bought the asset, the entity may be depreciating the asset, but the tax authority does not depreciate assets, instead gives capital allowance. As a firm has made an investment, bought shares in a company, the entity will be carrying their investment in the share of the company, usually at its fair value. The tax authority doesn't care about fair value. They only account for the cost of the investment. So what is going to be happening here is that there is always going to be a difference between the way or the amount at which an entity is carrying an event or a transaction and the amount at which the tax authority recognizes that transaction. So the difference between the carrying amount of a transaction and then the tax base of a transaction is what we refer to as temporary difference. TD, temporary difference. So the temporary difference is simply the difference between the carrying amount of a transaction and the tax base. And the tax base. Note that temporary difference can have two effects. In other words, the temporary difference can either be negative or positive. Stay with me carefully here. That is, the temporary difference can be negative or positive. How is that? When the temporary difference is positive, it simply means that the carrying amount of the asset is greater than the tax base of the asset. For that reason, this results into a taxable temporary difference. And I'm going to explain this for you in a moment. A taxable temporary difference. A taxable temporary difference. Now, what's the meaning of that? What's the meaning of that? Stay with me carefully. What's the meaning of that? So let's say, for instance, an entity bought shares or buys shares. Let me give an example. So let's say that KK Limited buys 100,000, or let's say 10,000, or let's just say 100,000 shares in MTN Ghana PLC at whatever. Let's say that is 0.75. We don't know the current share. I'm just using that as an example. At 0.75 Ghana cedis per share. Stay with me carefully. So they bought this at whatever on 1st April 2021. But then at 31st August 2021, that is the year ended of the company, the share price of MTN Ghana PLC is now 1.25 Ghana cedis per share. Please know these are just examples, okay? That doesn't mean that's the current trading. So how do we account for this? Stay with me, stay with me, stay with me, stay with me, stay with me carefully. Now, there are two standards here. And in case you don't know about it, there are two standards here. So the examiner gives us additional information that tax rate is 25%. For the entity, it's a traditional corporate firm, so the tax rate is 20%. So what is going on here? What is going on here? You realize that there are two accounting standards in play or at play here. That is IFRS 9, financial instruments, and IAS 12, income taxes. Why is IAS 12 coming to town? IAS 12 is coming to town due to the tax rate that the examiner has given us in the question. Assuming there was no tax rate in the question, they would have only dealt with what? IFRS 9. Now, since the company is buying shares, this is a financial asset. It is an equity investment that they are making. It is an equity investment. And it could be carried at P&L or carried through OCI. So because the question is quiet, we're going to be assuming that this equity investment in MTN PLC is carried at fair value through P&L. Why? Because this is the default treatment as per financial instrument or financial assets in accordance with IFRS 9. So let's see the initial recognition as per IFRS 9. So as per IFRS 9, what's going to happen? What will happen is that on 1st April, when they bought the shares, we're going to be having the fair value. And that is the 100,000 shares they bought times 0.75 Ghana cedis. And that's going to be 75,000 Ghana cedis. That's the fair value on 1st April 2021. Now, what is the double entry for this? You debit equity investment and you credit what? Cash. You debit equity investment and you credit cash. Please note, when we mean stated capital, okay? So that's 75,000 and then you credit your cash. 75,000. Actually, this is a non-current asset for your information. So it's an equity investment, but it goes under a non-current asset. Now, this is the cost of the investment. But then at the end of the year, on subsequent measurements, we need to look at a fair value. That is on 31st August 2021. Now, the fair value of that same investment is now how much? An amount of 1.25 cedis times 100,000. Now, that is going to give us an amount of what? 125,000 cedis. So stay with me carefully. On subsequent measurement, what is going to happen is that there is a fair value gain. Because if you compare the initial value of 75,000 to the year-end value of 175,000, there is a fair value gain. So the fair value gain is going to be 125,000 minus the 75,000. And that is going to give us an amount of 50,000. Does it make sense? So this 50,000, what is the double entry? We debit the equity investment with that, and we credit the profit or loss account, P&L. Why? Because it is carried at fair value through P&L. Because it is carried at fair value through P&L. Now, this is it about IFRS 9, equity investment, financial assets. But you are not done, because the examiner trapped you with a tax rate. So the question you then ask yourself is, what is the tax consequences of the shares that KK Limited has bought? So we look at it. At the end of the year, the entity is carrying the assets. So the carrying amount of the investment is what? 125,000. But you see, the tax authority doesn't look at fair value gain, fair value loss. So what happens is that the tax authority will be recognizing the investment at its cost. So the tax base of this will be the cost of the investment. Why? Because the tax authority is waiting for you. When you sell the shares and the money you get exceeds the cost, then you will pay tax or you get a tax deduction. So for tax purposes, the tax base of this is going to be the initial cost, which is what? The 75,000. So when you compare it, you realize that the carrying amount is greater than what? The tax base. And that results into what is called a taxable temporary difference. Now, immediately there is a taxable temporary difference. It means of 50,000. So this taxable temporary difference results into a deferred tax liability. What does that mean? It means we are assuming that if you are selling your shares today in MTN Ghana PLC, you will sell it at 125,000 Ghana cedis. But you spent 75,000 Ghana cedis. For that reason, you are making a profit of what? 50,000. So that potential profit you are likely to make is what is called the taxable temporary difference. Will you sell it? We don't know. Are you selling it? No. But because the carrying amount is greater than the tax base of the investment, it results into what? Taxable temporary difference. So IAS 12 states that provide for the future tax you are likely to pay on this 50,000. So we bring in the tax rate, which is at 25%, and that gives us the deferred tax liability. That gives us the deferred tax liability. So 25% of 50,000 that's 12,500. So that is the deferred tax liability. That's what I'm illustrating to you here. That's what I'm illustrating to you in this diagram here. That when the temporary difference is positive, which means the carrying value of the asset is greater than the tax base, it results into what? Taxable temporary difference. And this is just one example where you are seeing IFRS 9 in town, but there is an IAS 12 along with it. So this deferred tax of 12,500, you provide for it because you are likely to pay for it in the future next year if you sell the shares. If you sell the shares. And so this results into a deferred tax liability. Now, what will be the double entry for this? What will be the double entry for this? It is going to increase the current year tax liability. So we're going to be debiting profit or loss with the 12,500 cedis. And then we credit deferred tax. That's in the statement of financial position. With that same figure, 12,500. Remember, deferred tax is a non-current liability. And note, even though we are saying debit P&L account, technically you are adding it to the income tax expenses for the year. So when we say debit P&L, we don't mean bring it on the face of the P&L as a separate item, but we mean you should bring it there in terms of the issue about this one, in terms of the issue about this one, about the income tax for the year. Now, assuming this equity investment was carried at fair value through OCI, then this deferred tax will be taken to OCI and deducted from that fair value gain. And we'll get into some of these things much later on in that case. But that is the principle of when there is that deferred tax figure coming in as a positive from the temporary difference. Any questions, please? Any questions? Any questions? Any questions? I see some comments coming in. Let's see if I can address those comments real quick. Monyeka said, please also incorporate the deferred tax implication when there is a change in intention of an asset. Okay. Gonna be looking at these. Emmanuel Jabin said, I'm enjoying these lectures, watching from UPSA. That's awesome. Emmanuel, thanks for joining us on the live stream today. In that case, and I see some of you guys coming in. Give us a thumbs up on the video and also share the video. Let us reach as many students as possible watching the live stream. Let us reach as many students as possible watching the live stream. Okay. Any questions? Any questions? So the opposite is true. The opposite is that when the temporary difference is negative, it means that our carrying value is less than the tax base of the assets. Okay, meaning for some reason, the entity has actually has an impairment in the asset, or for some reason it's a liability in that particular case. So when the carrying amount is less than the tax base of the asset, it means that results into what is called deductible temporary difference. Deductible temporary difference. Deductible temporary difference. So whilst taxable temporary difference leads to deferred tax liability, okay, deferred tax liability, deductible temporary difference results into what? Deferred tax assets. Results into deferred tax assets. This is what you need to understand when we talk about these items. This is what we need to understand when we talk about these items. So that's the idea. That is the idea. So basically, when we talk about deferred tax, this is the first level. This is the first level. Any questions, please? Any questions? Had said, when do we take the capital gain tax into account? I don't know the context in which you are asking the question, but the capital gain tax will come in if we are looking at an asset that we are selling, in which case then we will still make the provision for that. Is why we are comparing the carrying amount and then the tax base of the asset. So capital gain will only come in when you actually sell the assets, and the returns you make on the assets, the tax you are supposed to pay on that. So at the end of the capital gain will come in when you actually sell the assets, and that is when you look at whatever tax you are supposed to pay as compared to what provisions you've made in your financial statement to find out if you need to pay additional amount of money or not pay an additional amount of money in that case. So hats, that is the meaning of that. Then Precious Okechi said, enjoying your explanations. Okay, that's fine. In that case, that's fine. So when we talk about deferred taxes, you will be saying no. So when we talk about the deferred taxes, that is what we need to understand in that particular case. So this is the first time. This is the first time. Now, assuming we are still dealing with KK Limited, the shares that we bought from KK Limited, in the subsequent year, that is where movement in deferred tax comes in. That is where movement in deferred tax comes in. And I'm going to be concluding around here today because of time constraints. And God willing, tomorrow we will look at the second aspect of it, then pick some questions, very, very critical questions, and see how we do the computation and how we account for the deferred tax assets, deferred tax liabilities. But let me emphasize this. Let me emphasize this very clearly to you. that deferred tax could arise when dealing with IAS 16, when dealing with IAS 40, when dealing with IFRS 2, when dealing with IFRS 9, when dealing with IAS 37, when dealing with IFRS 15. So all these standards, when you are dealing with them, they are assets, they are liabilities, they are income. All right. And so you have to find out, how do you deal with the tax effect on all of these things? And God willing, tomorrow we're going to be looking at the second part of this discussion, but most importantly, take some questions up to see how you can actually understand IAS 12 income tax liabilities. I hope that the explanation was okay for you. You understood it very well. And like I say all the time, taxes is not supposed to be difficult. It's very simple. If you understand the basic concept, the basic principle, and why we are doing what we are doing, it becomes very easy for you in that particular case. Lamini said, God bless you, sir. God bless you too, Lamini, for joining us. And so that is it about this. And God willing, tomorrow we will look at the final part of IAS 12, income taxes, take some questions and see how we can apply that in that case. And that is all that you need to understand about income taxes. Thank you very much, you guys, for joining us on Facebook as well as on YouTube. And for those of you who give us a thumbs up on the video, shared the video, thank you very, very much, because I mean, it really helps us a lot. That is the only way we get to grow the community. We get to reach a lot of people. And in case you've not subscribed to the channel, also make sure you subscribe to the channel and click the bell notification icon. That way, when I go live, you will be the first person to be notified, so that you will be able to join the stream tomorrow at 4:30 p.m. We're going to be continuing with the discussion in that case. We will continue with the discussion in that case. Now, if you're not following me on Instagram, also make sure you follow me on Instagram. We post other content there. Please note also that the audio or the podcast version of our lectures is also available. So if you check the second link in this description or in this video, you can get to all our podcasts, or wherever you get your podcast from, whether Spotify, Google, Apple Podcast, wherever you get it from, just search for the name Nhyira Premium. I should be everywhere based on what I receive from my team. So wherever you get your podcast from, just search for Nhyira Premium, and then you'll be able to get access to our audio podcast, so that you can study very well in that case. So that is it. Emmanuel Ejabin said, I missed the time today. Okay, so like I said, subscribe to our YouTube channel. Click on the bell notification icon and select all notification. That way, when I go live, YouTube will send you the notification, so that you don't have to forget about the time. And that is the way you can really stay up to date. So subscribe to the YouTube channel, click the bell icon and select all notifications, so that whatever content we put out there, you will be notified by YouTube. Then you can click through and join in that case. So thank you very much for joining the stream. Always a privilege coming your way and assisting you, providing with some blueprints in that case. So I'll catch you same time tomorrow as we continue with our discussion of IAS 12 and also solve some questions. Till we meet again, you stay safe and you stay blessed. Bye-bye.